So today we're going to do a bit of an education video, and I really got this idea from a comment in yesterday's video, which was a bit of a negative comment, which I thought really sums up the market at the moment and the fear that's out there. And also with what I've noticed in the last kind of couple of months is seeing so many retail investors leave the scene. As me that makes a lot of these content on YouTube, which is very popular with retail investors, is being very clear with me, with other channels, to see the amount of retail investors that have left with the decline in YouTube views and everything like that. And it's very clear and evident that there's a lot of retail investors that have left the stock market, as well as a lot of retail investors leaving the stock market. That's also the main reason why that's happened, is because unfortunately, even though the mindset of a very good investor or a very good retail investor should be, okay, when max fear is out there, max fear creates the best buying opportunities. Unfortunately, rather than having that mindset, it's kind of, okay, the fear is out there, the stock market's going down, okay, this isn't worth it, I'm going to leave. You can't make money in the stock market. And when stocks go up and they're at all-time highs, unfortunately, that's where sometimes the retail investors get sucked into buying on the hype when stocks are at 52-week highs. But the only downside to that, or the risky point to that, is that when you are buying stocks at 52-week highs, or especially really high valuations, you then put yourself in a position where you're actually more favored to go on a big downtrend, or you're more likely for a stock you're investing in to fall off a cliff. And unfortunately, that's the cycle that retail investors fall into. They buy at highs and they sell down at lows. And it's been evident once again, no matter how much education, how much you listen to the experienced investors out there, like Peter Lynch, who says up on One Up on Wall Street, which is a fantastic book about investing, is that this is why a lot of people aren't successful in the stock market, is because they invest off that emotion, is they make the bad decisions. You know, the really 50% of investing is kind of trying to control your emotion, and when stocks do go down, that's actually when you're presented with the really good opportunities, and when stocks go up, that's actually where you want to be fearful. But unfortunately, the classic thing for a lot of retail investors why they aren't successful in the stock market is to do the opposite. Something very clear to say to that is, 2 years ago when we were going through the CV dip, everyone went, oh, you know what, stocks have lost 50%, I'm not going to be buying any of the stocks. And the people who were rewarded, which some of you guys might have been in that time, obviously for me, obviously you can see the YouTube videos at the time I was putting out through the CV dip, I had the confidence to kind of go, okay, in the longer term, this is going to be a really good buying opportunity. And I bought them stocks, and what did you have? There was plenty of stocks that was then sold for fantastic gains. And some of these also that offered even the better opportunities, because what you got to realize is that when the stock market falls 20-30%, if you're more of a higher risk tolerance investor and you are going for more growth stocks, unfortunately, part of the game of being a growth stock investor is that when you have a lot of these individual stocks in a stock market crash that go 20-30% down, unfortunately, being a growth stock investor, that's more than likely going to lead your stocks to fall even more than that. So for example, with the current crash that we're on, something like a Block, for example, is down 66%. It's same if you go back to the CV times, you look at something like a Block, for example, peak CV, Block lost 54%. What did it turn out to be? It turned out to be a fantastic buying opportunity, and the people that were rewarded buying Block, for example, at $38 would then very quickly, and obviously we did go to quite extended valuations, however, you got the rewards from buying in the dip. You were making returns of 500%, 600% within a year basis. And obviously that was a bit of a one-off situation, and potentially buying in this dip, you don't expect anything crazy like that. But when you look at these, for example, Block in the next 5-10 years, Block isn't going to be $88 if it carries on performing absolutely, fundamentally as good as what it is. And this is the thing, is that people, and this is the big mistake that's happening right now in the stock market crashes, don't listen to the negativity, and also remember to invest on what the company is going to be doing financially in the next few years. Don't look at what the share price is doing right now. And that's in particular what's happening right now. There's a lot of fear out there, especially in the retailing space, even on the YouTube scene, which are the channels that are exploding massively at the moment. It's a lot of the channels that are very negative on the stock market. Very similar that if we went into a bit of a bull market, a lot of the channels that were doing, particularly bullish videos on the stock market would then come the popular videos on YouTube, for example. And that's the big thing, is not to fall in this trap, because in what we have right now is one of the best buying opportunities that we've had really since the last kind of 2 years. And since then, I would say potentially the 2020 crash was probably the best buying opportunity that we've had since 2008, which is unbelievable. And same again, there's a lot of quality companies out there. Even if you want to be a bit of an index investor, but if you're especially high risk opportunity, if you're a bit more of a high risk investor, opportunities, for example, like a Shopify, for example, which crashed 34% in the CV dip. If you had the rewards to buy that in the CV dip, then you returned over 300%. And the crazy thing is that that's over a 1 year period. When we actually start talking about long-term investing and buying in these dips, you'll be talking about Shopify without doubt. Realistically, could Shopify go from $352 to a $3,000 stock in the next 10 years? It potentially could if it carries on doing what it's doing at the moment. And at the moment, what we're actually getting presented with is these high growth stocks like Shopify, like Block, for example, Etsy, Mercado Libre. And even these are quite big market caps. So these are a little bit harder to kind of multiply up. But there's actually 1 billion, 5 billion, 10 billion companies, which are in a lot more early stages with a lot more growth, that potentially have so much potential to multi-bag these sort of valuations right now. So for example, for me, one stock that I'm potentially looking at that could be a multi-bagger from here is HIMS. For example, HIMS hit a 52 close of $2.72. If this was to 10 bag, that would be putting it around obviously a $27 stock. Now actually that would actually be near the peak of February 2021, which I do think was a crazy valuation. But in the next 10 years, can HIMS and hers get back up to a $20 range, which could potentially give it a 10 bag status? Yes, it could. The share price could multiply from 10 from here. And this is very quickly, this is like a little bit of a teaser how this can happen, for example. So if you look at like the 11th of May, for example, a stock that HIMS hit actually $3.11. It actually went down to $2 on that day. Very quickly, a stock like this that is so beaten down and is performing so well actually can slingshot up 40% within 2 or 3 weeks. And that's without the stock market actually having much of a recovery. You translate this to a stock market recovery of where the indexes, for example, like the S&P and NASDAQ go up 10-20%. A stock like HIMS is going to go unbelievably phenomenal on a share price run. And very quickly you talk about the potential of a HIMS and hers that is already beaten down at massively sold off valuations, can go on to crazy valuations. And one of the biggest mistakes that I'm seeing in the stock market crash is, once again, people looking at these share prices rather than looking at what the company is doing financially, fundamentally, and thinking more than anything, okay, where's this actually going to be in 10 years and where's it going to be when we move out of this crash situation? Because at the moment you have the best situation ever where you have like HIMS, which should be somewhere probably around a $10 stock, and you potentially for a long period of time picking a stock that should be $10 at $4, $3, and you can buy a really good average in a company that should be valued so much higher than where it is right now. And that's an absolutely phenomenal opportunity. And right now at the moment, this is where you kind of have the best opportunities to get multi-baggers that are stocks that should already be valued a lot higher than where it is, or it's valued a lot cheaper than what it should be valued at, and then you factor in the growth in the next 5-10 years, and very quickly these stocks can slingshot and do very well and give you really good returns. And this is the opportunity that people are missing. They're looking at a lot of these stocks at the moment and judging companies off share price, going, yeah, it's a terrible company because the share price is down however from highs, rather than looking at the dips and the crash as opportunities to make very good money. And even though people will be at the moment, the most bearish will be to growth stocks because the share prices are down, rather than looking at that as a fear point of view, and the thing with growth stocks is there is more potential for a lot of these opportunities to potentially go wrong and then not to work out as investments. If you ever read, I would actually get the copy or a copy of the page on the screen if I had the book with me, but it's packed up somewhere at the moment. But if you ever read One Up on Wall Street by Peter Lynch, he actually says that really to be a successful investor, if you ever pick 10 stocks and then only, one of them 10 stocks go on to multi-bag, 10x return, your returns, your annual rate of returns is phenomenal. And that's all you need from a multi-bagger stock. And right now, what do we have? We have so many potential opportunities out there for stocks that have lost, over half the value, for some of them even more than half the value. And you could potentially be looking at staring at the moment, very much like a CV situation, where if you bought the dips there, which is crazy to think we're talking about a dip at the moment, which has taken prices back down to the CV situation. But you're starting to talk about, you know, stocks at the moment that have multi-bag status at the moment. And like Peter Lynch said, you know, to have really a successful investment return, you know, at the end of the day, you know, if you pick 10 stocks and only one of them puts in a 10 bagger status, you're going to absolutely smash it. And at the moment, because there's so many stocks down, and you know, like HIMS is one of my stocks that I think could potentially 10x in the next 5-10 years. But you know, you talk about one stock and you know, you can get very good annual returns of, you know, 20-30% a year from that one stock that needs to work out. You know, you start talking about the opportunities that are here, and the opportunities here at the moment is unbelievable. That you talk about, well, you know, even if you're really unlucky and you only pick one stock that does absolutely phenomenal in the next few years, you know, obviously you want your other ones to kind of do okay, you know, maybe, you know, you have a couple that have 20% returns, 30% returns, 40, 50, 60% returns, but that one stock that really hits that home run, you absolutely destroy the market. And at the moment, you're presented with that many opportunities, that you potentially could be staring at so many stocks that you only need maybe 2 out of the 10 to land and do very well for you. And you know, one of them gets a 10 bagger in the next 10 years, one of them hits a 5 bagger in the next, you know, 10 years. And if you do that, your returns are going to be absolutely insane. You know, you are going to be, you know, up there with the lines of the best investors out there. And that's what you have in here. At the moment, you've got so many amazing stocks on sale that it's a bit like shooting fish in a barrel. And even if you do mess up completely in that, you know, them 10 stocks that you pick, only one of them really does hit off big time, that's all you need. And that's what you're presented with now at the moment. You're having that opportunity to pick some fantastic growth stocks that can really land very good returns. And it's not even like fantastic growth stocks at the moment, even the high risk stocks. You know, you're starting to get the likes of, you know, PayPal and Facebook. I don't think the likes of PayPal and Facebook will ever be, you know, multi-bagger stocks, but even that, you know, that's down 50%. And even when you look at that, you know, you're looking at a lot of these big blue chips at the moment that are basically offering themselves, you know, really massive opportunities out there that you can pick up, you know, good valuations for them. And, you know, potentially they won't give you that kind of 10 bagger status, but potentially, you know, a very safe company that potentially could in the next 10 years offer you a, you know, maybe a 3-4x return from here. Very much so. And an example of that would be, PayPal's a little bit more in its mature stage right now, but I haven't got all the data for PayPal because it only came on the stock market in 2015. But let's say we went over a 5-year period. Let's say we went from the 7th of August 2015 to the 7th of August, or let's do July actually, because that's where the chart starts. Let's do the 10th of July to the 10th of July 2020, so over a 5-year period, and your returns would have been perfect. Got it bang on there. I didn't think it would work like that. The 10th of July 2015 to the 10th of July 2020, you would have got a 414% return. And at the end of the day, PayPal's a safe stock. You know, we're not talking about a high risk stock. We're not talking like HIMS and hers here. We're talking about a very well-developed big blue chip company and a very safe company. And even in that 5-year period, you're talking, you know, a mass amounts of return. And then you work that out over a 10-year period, or potentially, you know, let's talk about PayPal. Let's say that PayPal is what is happening at the moment, and PayPal went from $34 down to a $15 opportunity, then you're absolutely making a ton of money from there. So, you know, this is what I wanted to make a video on today, is that don't listen to a lot of the fear out there, and make sure you're not judging companies off the stock prices, and make sure you're not making judgments of businesses and investments off emotions, because a lot of people are doing that at the moment, and they're going to regret that decision massively in the coming few years when we come out of this kind of bear market cycle. So yeah, a little bit of an education video today, just talking about that situation, something that I've noticed massively in this last kind of few days and months, that this kind of bear market's been going on, a lot of bad decisions being made, and I thought I'd talk about that one. But yeah, hope you enjoyed the video anyway. If you could, hit that like button as always, and if you are on the Patreon, I did drop a live Q&A session out there yesterday, so do go make sure you watch that if you are on the Patreon. But yeah, hope you enjoyed the video, and I'll catch you in a bit.